Just a reminder that the content of this presentation is general advice only. That is, it has not taken into account your personal financial circumstances or particular needs. Before acting upon any of this general advice, you should consider it very carefully or seek the help of a financial professional. The rest of the information in that disclaimer is important. You should read it or consult our product disclosures statement, which you can download from the Think Markets website. Okay, good morning everybody, and welcome to today's presentation where I'll take you through all the key moves from markets for last week and have a look to the week ahead. We'll kick off with cryptocurrency, and it wasn't a great week for crypto, mainly due to moves in other markets. So unfortunately, we're in a situation where crypto is not in control of crypto's destiny. It's mainly to do with risk on, risk off in equities and interest rate moves, mainly due to that Federal Reserve meeting and press conference. We'll talk about that in a sec, but Bitcoin down 2.1% for the week. Alts fared worse, and in some circumstances, much worse. Ethereum down 6.1%, and they fell away from there. The Fear and Greed Index at 26. That's yesterday's reading, so probably worse this morning. It is in fear territory, but in theory up from the extreme fear that it was at last month. Don't expect it to get better anytime soon, unfortunately, because, as I said, the major catalysts seem to be coming from outside of crypto. If there is a silver lining, it is that we have not taken out yet the November lows after the initial discovery of the FTX disaster. So 15,563 continues to hold on Bitcoin, but it is being compressed in that dark pink zone, the all-important long-term downtrend ribbon, which tends to suppress prices anytime price gets close to it. We can see that a peak was made early last week at 18,376, and to be fair, it was starting to look half decent there. Well, maybe let's call it a quarter to two-thirds decent, potentially challenging that supply zone there that tops out around 18,608. Look, we're very much back in the downtrend now, below the short-term trend ribbon. That's the orange zone, and probably based upon the candles I can see, more likely to test 15,563 again than go up and take out 18,376. That's going to be the key level. Close above that would change the thesis. Otherwise, business as usual for Bitcoin, which is very much down to sideways. Looking at Ethereum, we're seeing a very similar technical picture. Again, looking half decent there on, I'm going to say it was about Tuesday, looking at that candle, because we can see the two small candles here are Sunday, Saturday. Then we've got Friday, Thursday. In fact, it was Wednesday. Tuesday was an up day. 13.52 was the top. Again, going to need to close above that to have any chance of looking at this long-term downtrend ribbon, which again continues to suppress, continues to strangle prices. 10.71 is the key level to the downside. Beneath that, we will take a look at 8.80. But the trend is your friend in both cases, and in both cases, that trend is still firmly set to the downside. Let's have a look at the only decent-looking chart in crypto now. It's the OpenNetwork. It is one I did mention. I've mentioned a few times in these sessions on Monday mornings. I initially started talking about it around the end of October, start of November. It's been about the only thing that's gone up since then. Probably Trust Wallet is the other one that's done well. I also tipped you that one. If you're on it from any of those recommendations, I would say stick with it for now. I think, it's past tense, but, taking a little bit of profit off the table after that 290 candle wasn't crazy, but you're doing nothing more than trimming this one with a view to holding the rest. It could well have another look at 3. It could well go beyond based upon the patterns and the trends we're seeing. Some really great candles, certainly a predominance of white candles there. So if you have to trim, only trimming a little, the message there is to hold the bulk of that position for further potential gains. Let's bring it back to equities. Now, it wasn't a great week for stocks, as it also wasn't a great week for crypto. They were moving on the same themes. Starting off in America, the S&P 500 in the US down 2%. That's the benchmark. But if we look at the value index, that's the Dow Jones index. It's the 30 biggest stocks in the US. Over the last few Mondays, we've talked about how They're big, they're defensive, they're liquid. It's where fund managers who have to invest. Don't forget that money keeps rolling in. They're mandated to keep buying. It's where they go and hide when they're worried about where stocks are going to be in the future. So the Dow has done really well. You can see even in this small sample here of last week's performance, outperforming the S&P 500 and then underperforming the S&P 500. That's the key message. The growth index of the NASDAQ down 2.7%. We'll have a look at some charts. That'll become clearer in a second. The CBOE volatility index edging slightly higher, but off its highs for the week. The Nikkei in Asia, looking at Asian equities, the Nikkei in Japan down 1.34%, Shanghai Composite 1.2%, and the Hang Seng down 2.6%. For the China-related markets, they are still up for the month. However, in Europe, far more severe falls, and the data out of Europe has been pointing to potentially a more severe recession in 2023 than some of those other regions. We talked about how the Dow Jones is often perceived as representing the value trade, and we can see just how well value has done from those October lows. There was, let's face it, a fair bit of cash out there waiting to find a home, and it got into the market via these big blue chip stocks in the US. On Tuesday, in Ask the Experts, you might have caught that recording, we discussed the possibility. Don't forget our Tuesdays before the US Tuesday, being based here in Australia, the possibility that this candle here, this is the Tuesday candle, so coming back, you've got Friday, Thursday, Wednesday, and Tuesday. That was the release of the CPI data. If you look back to the prior release of the CPI data, which was better than expected, it was this move here from that low, a massive move. We talked about it, of just how extraordinary that move was on the back of the better than expected CPI. And I think markets were positioning for something similar if this one came in better than expected. And it did. I'll give you the numbers as we get through the presentation, but the message here, it was better than expected. And I think a lot of the lazy money was banking on the market pushing through this little pullback and going up and potentially testing those all-time highs. It didn't happen. Why didn't it happen? Because there were some other funds, some active fund managers out there that were waiting to sell into that rally. And if you are a big fund, a big whale with a bunch of stock to sell, you do it when everybody else is buying. That's how you get the best prices and the most liquidity. And that's what that open represented for these sellers, the better than expected CPI data. And we did say, hey, watch out on Tuesday for potentially one of these two candles happening on that evening. And it could create one of these AB patterns that we talked about. And then when you break beneath the middle trough of that AB pattern, it's usually lights out. That's almost exactly what we saw occur on that Dow Jones Industrial Average. Looking at the S&P 500, which is, as I said, the benchmark, it didn't rally anywhere near as much as the Dow Jones. It got stuck in that long-term downtrend ribbon. And if you've been following my ribbons for any length of time, you know just how effective they are at pushing down prices, at suppressing rallies in bear markets. That's what's happened here. We've backed off. For all intents and purposes, I have to assume now that this downside move, which has begun last week, will continue. We'll probably test maybe a 36.47, maybe a 36.98. I do think there will be some demand down there, and potentially we could create a second higher meaningful low, a second higher swing low compared to 34.91, and maybe that will then start to create the conditions for, technically at least, for the end of the bear market. We haven't seen those big swing lows come in higher just yet. Okay, so this is the chance for it. Hey, if that doesn't happen and we just crumble through 36.47 through 34.91, then we are very much in next leg down of the bear market phase. Look to the upside if I'm wrong, like watching a 41.01, you can see two 41.01 prints side by side there. That's clearly now the most important level to the upside. Close above that, and we probably will head higher to 43.26. The big reason why I didn't get bullish on stocks through that October-November period was this chart here, the NASDAQ Composite. So whilst I did have to concede that the phase we were in, or the bear market phase we were in, was over based upon that Dow Jones, I was very clear that I would not declare a new bull market until the NASDAQ did the same thing. It never did, and I was quite skeptical it could. We saw these highs pop in here, 3 of them around that 11,492 to 11,614 level. Quite decisive, I think, off that long-term downtrend zone. Again, and pushing lower potentially. 10,262 is the target, and failing that, a break of 10,088, I think is lights out, and we are very much in next leg down of the bear market phase. I don't normally throw you the Russell, but I thought I'd just pop that in today because it does show, if you look outside those big blue chips in the Dow Jones, you go much broader to the small caps, for example. I'm just going to flick back to the composite here and back to the Russell. You can see very much the growth trade did not budge. The trends did not budge, and without the growth trade, it is impossible to say that the next bull market in the US has begun. We're still very much in the bear market. It's another little interesting chart here on lumber. Lumber, of course, being a very important indicator of the health of the US housing market, which in itself is a massive contributor to US GDP. Many ways here, because obviously if housing is strong and property prices are going up, we feel that wealth effect, and we go out and we spend more money. That's good for the economy. If lots of new homes are being built, we're going to go out and we're going to spend money to furnish those homes. When the opposite scenarios are in place, clearly that's bad for the US economy. And the US home building market is a huge employer as well in the US economy. So lumber heading down, it is a very, it has been a very reliable indicator over decades and decades of that US housing market, because here's a stat for you: 9 out of 10 homes built in America are still built with wooden frames, basically due to availability, the economics, the economies of scale, etc. So this chart, very much the trend is your friend here, and I don't think it's a great indicator of what could be coming in that US property market, the US economy for 2023. One of the big reasons why we did see that rally through October is China started to throw money at the zombie property sector. Order of magnitude about 200 billion now. A lot of it is in debt extensions, debt repayment extensions. Some of it's in new debt. I don't think the way you solve the problem of the Chinese property market, which is laden with debt, is by throwing more debt at it. The end user needs to be stimulated, so you need to stimulate the demand there. Property prices are falling, sales are coming down, and I think that's the main problem there. However, look, have to respect, again, a pretty solid rally, really from end of October, start of November, into that first week of December. It is pulling back. I think that's a message here with some of those US equities markets. It hasn't shown that A-B pattern. With the supply building, potentially we could see that 3,200. Until then, I'm going to say, hey, look, this isn't all that terrible. Short-term trend is up. We are bumping into that long-term downtrend ribbon and really just waiting for either the next signs of supply to continue this long-term downtrend, or potentially signs that, in fact, demand is coming in, those white candles, those lower shadows, to potentially break through. My tip is on the first scenario there, where we tend to roll over. And this could be the other shoe that drops for the Australian market, which we'll talk about later. Just for your reference, this is how the property sector is doing. You can see a substantial rally. We're talking, 70, 80% from those lows in the early 1000s up to as high as 2600. So it was significant, and that has been a major driver of the iron ore price. There's your segue. So this is the iron ore price in yuan per ton. So taking out those US dollar impacts, not looking at the Singapore dollar price, which is based in US dollars, but looking at the price in Shanghai. And you can see the commensurate rally there with that China property slash SSEC. Iron ore was up a little bit again last week, amazingly. I say amazingly because the rest of those key commodities, key growth commodities, came down. Some of them quite sharply. I mean, 2, 3, 4% falls, 6.4% fall for zinc. And I think that's very much to do with, again, with the moves we saw in the US dollar, expectations for global growth. This is a growth play or lack thereof. So that is a concerning slide there for me if you are an equities bull. I don't think it's helping you out. Looking at coke and coal now, and you might say, hey, why is coal in this section on metals? Well, because you take your coal, you take your iron ore, you take your nickel. You can see that nickel was down 3%. And you make your steel, which was also down a little bit there. And it's the steel that is being consumed by that that Chinese property market. It didn't have a huge week one way or the other, probably, but we can see that the overall trend, I think long-term trend, is still down. Looking at copper, Dr. Copper, because it is ubiquitous in industrial applications around the world in various industries, particularly obviously in construction also. So when we say the price of copper is strong, we say that the global economy is strong. It's 50-50. There are some supply side constraints here. So supply is very thin at both LME, London Metals Exchange warehouses, and Shanghai warehouses as well. And I think that has helped keeping it off the lows there. It hasn't changed its long-term trend. I think that's the message. Long-term trend is still down. We're seeing a little bit of that AB pattern there, 393 lower than 396, and some pretty bearish candles coming through on Thursday, and not a great response on Friday either. So chances are for me, we fall back into that long-term trend. We come back and test 350, but I don't want to get too bearish on this because you can see that short-term trend is up. We are in that light green trend zone there, which can support prices. So 50-50 bet on copper. Hey, forgive me for sitting on the fence there, but the technicals don't allow me to make a clear call one way or the other. Nickel pulled back during the week, but off its lows, you can see there, the short-term trend is still pretty strong. This isn't exactly pointing to terrible growth in 2023, but there are, again, a few supply side constraints on that one. For your lithium bulls out there, lithium carbonate prices are starting to roll now, and from a very gradual pullback we talked about a few weeks ago, it's starting to roll pretty hard. And the ramifications there for the lithium sector here in Australia aren't probably as substantial as you think. That might surprise you, that statement, because I think they have already rolled over in anticipation of some of this happening, and probably no coincidence there, the peak in both of those sectors coming on the back of that Goldman Sachs report. So if you're looking for someone to blame, maybe blame them. But it potentially is becoming a bit of a self-fulfilling prophecy that of theirs that prices will back off in 2023. Looking at the gold chart now, I know a few gold bugs out there. Look, again, it's a little bit like copper. It's trying to break its long-term downtrend. Well, to be fair, it's better than copper in that it has broken above its long-term downtrend. That long-term downtrend through my traffic light system. So obviously, if it's pink, dark pink, it's bearish. If it's orange, it's neutral. If it's green, it's up. Trying to transition. Short-term trend very well established there to the upside, and you can see 1727, 1764 holding, and there's plenty of demand, I think, coming in around that 1760 zone. So for the gold bulls, last week wasn't great. We saw it push up on the CPI, then get whacked on the FOMC. I think you've got some problems here, but yeah, I think you're hanging in with your risk. If you're getting nervous, trim a little, but I still think you want to back that short-term trend and that potential transition in the long-term trend for now. So I'm going to stick with gold, but just noting that looking at the candles towards the end there, and the fact that 1825 didn't push too much higher than that sort of 1808, that some of that short-term upside momentum is dissipating. Short-term downside momentum on crude oil is very much in play here. You can see the light pink zone there, very much skewed to the downside and pushing prices down. So much like we said, that dark pink zone, the long-term trend will suppress prices. You'll see it in the short-term trend. It's clear as day here. Work back there through that light pink zone and see how well it has predicted where any short-term rallies will terminate. 82. 36, 77, 77, and so forth. Look, long-term trend has now swung officially to the downside. I tipped this a few months ago that the bull trend was over, so no surprises there. I do think we'll probably see high 60s on this, and I do think you can fade rallies. It was an up week, however, got to respect that. 3.6% on West Texas, 4% on Brent natural gas popping up. That chart's coming up. Before we get there, Aussie dollar coming off sharply. We'll discuss some of the reasons why. It had a topsy-turvy week as the US dollar index came off its lows there. Still showing a decline, but coming off its lows. and bonds yields were higher in Australia for good reason and lower in the US. That's the natural gas price there. It looks stuck in the middle. I can't really make a call. You can see long-term, short-term trends both on the neutral. You've got black and white alternating candles, and the price action is, let's face it, rubbish. So when you get rubbish, there's no point making a call. Let's keep going. Interesting here on the European gas futures, the possibility that we're going to see this huge blow off in energy prices in winter does not seem to be materializing. That trade seems to be quite dead. And we could see thermal coal prices pull back as a result of some of the pressure coming out of those markets. I do think this trend is turning. You can see there that the long-term trend is very much starting to flatten out. It did go orange for a little bit. So yeah, look, it doesn't necessarily spell disaster for your local coal stocks, because the 380 we're seeing compared to the 50s and the 40s pre this run is still astronomically higher, and they even if it was to pull back to 300, which sounds like a substantial pullback from here, they are still printing money hand over fist. But I do think, no pun intended here, the heat is coming out of some of those energy trades, and uranium coming down in kind. It does need those energy prices to continue to tick up to look like a valid alternative. So crude prices coming down, uranium prices coming down as well. The US dollar index was heading lower earlier in the week on the back of that CPI data, because it was better than expected. Inflation coming off, less reason for US interest rates to be up, less reason for the US dollar to be up. But we did see a big bounce back there in those last two candles, Thursday, Friday, on the FOMC. I do think the tide has turned, though, to the downside. Probably the trend will be down here. I say probably because, let's respect those last two candles and see how we go. We could get a move back into, say, 105, 106. We could see some strength there next week. And we'll need to see a follow-up of that strength to reverse this thesis that the short-term trend there is turning the long-term trend. And this big bull trend of 2022 has broken. Australian dollar would suggest that maybe there's more in it to the upside for the US dollar, obviously an inverse relationship here. And you can see a huge rally. It was actually starting to look the goods here in potentially changing this long-term downtrend. But just as it is the case so many times, that long-term trend ribbon does finally get its way and crack the back of short-term rallies. It just does it over and over again. And that was that number there was the better than expected jobs data over here in Australia. And then we saw the big wipeout on the FOMC meeting on Thursday. This is a major supply event. That big black candle cannot be ignored, the significance of that. And I do think in line with that long-term uptrend ribbon, you do start to fade now any strength on the Aussie dollar. So by fade, I mean any sort of rallies now, high 67s. I don't even think you need to wait for 68, but starting to build up some short side exposure for what I do think will confirm the change of trend back to the downside for the AUDUSD. Looking at Aussie bonds, they did trend higher during the week because of some really strong employment data we saw, which did contradict some other bearish data on the Aussie economy. Talk about those in a sec. The US bonds trended lower despite that hawkish FOMC meeting, because the data is just looking really terrible at the moment. We didn't even see much of a response there in the twos, and I think the twos are starting to succumb to some of this recession fear, that despite the hawkish rhetoric from the Fed, the data might cause them to pull back. It's interesting to see the bond market there not really move as much with the stock market. Stock market definitely took a bearish bent on the FOMC numbers that were put out. Looking at the US yield curve, really confirming this likelihood that we will see a recession in 2023, because the curve, whilst the rates did come down, you can see there from 1 week ago, very slightly, and certainly down from a month ago. We're seeing, I think, quite a bit of steepness now coming in to that curve, and the inversion is a very reliable indicator of recessions down the track. Very quickly on Chinese data, because I know I've taken a bunch of your time already, and I'm just going to summarize them here because they weren't great. And we are taking these with a little bit of a pinch of salt because they predate the reopening or we can't really call it a reopening, but the easing of those COVID restrictions, and much of this data will predate the big stimulus package thrown at the property market. But fixed asset investment, very important growth fuel of the Chinese economy. How much is being invested in fixed assets? 5.3%. Still growth, but well below the expectation there of 5.6%, down from the previous 5.8%. Industrial production still being hampered by COVID restrictions, 2.2%, well below though 3.6% predicted in the previous 5%. And then retail sales, this is quite concerning, down 5.9%. Way below 3.7% expected, and the previous reading of minus 0.5%, and the unemployment rate ticking higher again. I think the big hope in China is that the reopening will stimulate growth. I'm looking at it the other way and saying that the reopening is going to stimulate infections, which will not stimulate growth. In fact, the big risk here, I think, for the world is that it creates massive supply chain shortages within China at a time that the world is coming out of these shortages, so reimposing those, and potentially seeing a sharp increase in inflationary pressures within China, which then is exported to the rest of the world. And maybe that's why the Fed was so hawkish. Let's keep moving. CPI, 2 in a row of better than expected readings. That caused that big jump Tuesday morning, which was sold into. And I think that's the key message from last week, that the smart money sold into this good reading. 0.1% in November versus the far more severe 0.4% in October. And hey, these are monthly readings. So if you go 12 times 0.1, you get 1.2%, which means that inflation is very much in control as far as the Fed's concerned. The core was a little bit higher there at 0.2%. That's still down though. And again, if you times that by 12, you're at 2.4%. Above the 2% that the Fed wants, but very close to it. Year on year, you're looking at 7.1% on the headline. That was down from the 7.7% in October, and well down from June's 9.1% peak. It does look like we're on the right side of that peak. The course, which strips out volatile food and energy, that was 6% in November. Nicely lower from the 6.3% in October, and well down from September's 6.6% peak. But, and there's the but here, the stuff that was still going up, like shelter, 0.6%, annualize that, it's still coming in around that high 7% level. And this is one of the big components of your average Americans, daily, weekly, monthly spend. Food is the other big component, 0.5% times that by 12. You're still at 6%. Yes, it's lower than the 10.6% year on year, but it's way above what the Fed wants. Restaurants, we like to go out and have a meal. That's still running at 8.5%. And then auto insurance, they were the worst ones there. We did see a decrease in energy, but that's fairly volatile. That was down 1.6%, but still showing a 13% year on year gain. And again, looking at shelter, food, energy, these are the major contributors to your weekly cost basket, still running much hotter than the Fed's target. And that brings us nicely to the FOMC meeting, where they did increase interest rates by 50 basis points, taking the policy rate to 4.25 to 4.5%. In the economic projections supplied as part of that meeting, this is what shocked markets, and this is why we saw such huge moves in equities and FX on Thursday, was that the Fed's projected Fed funds rate now at 5.1% at the end of 2023, 4.1% average for 2024, and that is way higher from the Fed's previous expectations of 4.6%, 3.9% respectively. So you can see 50 basis points higher than what the market was working off. The playbook the market had been given it prior was 4.6%. Now the market's got to think 5.1%, and the market's got to think, what are these guys doing? All the data is pointing to a weaker economy, and yet, if anything, these guys are becoming more hawkish. They revised up their inflation expectations 3.1% on the PCE, up to 3.5% for 2023, and averaging 2.5%, which was flat for 2024. The most frightening thing for me out of these economic projections was that the Fed now projecting unemployment to rise to 4.6% from the current 3.7%. And look, I haven't done the maths and I haven't checked the stat, but it's not, it's not tens of thousands of people that the Fed is saying will lose their job. It's hundreds of thousands, and in an economy like the US, probably maybe even in the millions. somebody please go find the stat, shout it back to me. But imagine that many people not having a job, then potentially not being able to pay their rents, their other interest rate payments, cars, student loans, etc., etc. What that does to the US economy is disturbing. Economic growth, according to the Fed, somehow still going to be positive for 2023. And they have confirmed that ongoing increases in the target rate will be appropriate to bring inflation down. There's the dot plot here. You can see topping out there at 5.1% now, but coming down in the longer run. And by longer run, we mean further out than 2025. But we're still showing, a rate in excess of 3% by 2025. And this is explaining why that yield curve is inverted. At some stage, the Fed, by their own admission, will have to cut rates because hopefully, A, their job on fighting inflation is done, and B, the economy is probably going to be in the toilet by then. Talking about the US economy being in the toilet, US retail sales coming out during the week, we did see another big miss there. They fell by 0.6%. That was worse than expected, a fall of 0.1%, and way down from the previous 1.3%. Then we saw the PMIs come out at the end of the week. They were again worse than expected on both the services side of things and the manufacturing side of things. And you can see there, after that big pop post-COVID, the trend is very much set to the downside on those PMIs. Just keep moving here. Aussie data now out during the week. We saw the NAB Business Confidence Survey, where we saw the biggest gap now between conditions and confidence on record. So the theme here is that Australian businesses are doing well right now. There's plenty of work around, and in terms of profitability and the work they're doing now, things are going very well. But if you start to look at things like new orders, they're starting to drop off, and they're seeing some weakness in demand from customers. So this is causing this big disconnect. Work's good now, but down the track, businesses are predicting things are going to get a whole lot worse. And as I said, the biggest gap between those two indicators on record. Conditions were down though, so they are starting to deteriorate, down in 5 out of 8 industries. Best still manufacturing, because they've just got to catch up. Wholesale, part of that too, restocking. And then mining, of course, the invincible mining sector, up 2 points. On the other side, anything to do with financial conditions, anything to do with interest rates, they were the worst impacted. Confidence fell again, now in negative territory for the first time in 2021, and led by substantial falls. They're big falls, 10-point falls in manufacturing, construction, and the important one there, retail. Leading indicators were softer, so forward orders, as I suggested earlier, are coming off. And cost pressures, that's the other problem, continuing to weigh, with labour costs averaging around 3% now in October. And that is going to be watched very closely by the Reserve Bank. Looking at the consumer side of things, that has fallen completely off the cliff there. You can see that orange line, but also that last little blip up there, the 3% bounce in the latest reading. Inflation, interest rates, and the economy still the dominant concerns for local consumers. Confidence for those with a mortgage bouncing back 11%. I'm going to suggest because of all the media hype about the Reserve Bank potentially slowing down, and in some cases people predicting that maybe they're done on the interest rate increases, and that gets down to the households. The households there still remaining extremely risk averse, and they are building their savings, paying down debt, and not investing in shares and real estate, because obviously they're still quite concerned about how much their finances have been impacted by those recent interest rate increases. Job confidence stabilised. Consumers remain relatively confident about the labour market. That's important. It still remains a poor time to buy dwelling index down nearly 3% in the deeply pessimistic territory. Okay, looking at the Australian employment data, and that was the reason why the Aussie dollar had a huge pop on Tuesday, nearly breaking out of its downtrend, as we discussed earlier. 64,000 jobs created in the Australian economy, and you can see there lagging a little bit on the full-time workers, but still a very strong reading. The estimate was 19,000. The previous was 43,000. Unemployment rate was roughly steady at 3.45%, but extreme strength seen here in the participation rate. So if economic conditions are strong, people are confident about finding jobs, they'll come out off the bench, as it were, and try and find that job. So that is the highest participation rate on record, and this is a very strong reader of the employment market in Australia. So the Reserve Bank will be pulled in different directions there, isn't it, by those business and consumer surveys compared to the employment data. Okay, looking at the ASX 200 technicals here, we can see that this massive value-based trade, this is all value. This is our big four banks and our big three resource companies. This rally from October, it is almost identical to the Dow Jones Industrial Average rally. It is at odds with anything growth related. It has broken in that we are now lower peaks, lower troughs. You can see 73.76, 72.57 on the peak side, and then now we're a couple of lower troughs, and the next one will be lower. We don't know where it's going to be, but it will be lower than 71.56. Short-term trend zone under pressure. It is still doing its best, or putting its best effort here of supporting prices. We'll see how that goes. If it does crack, 7,000 is the next level, and below 7,000, I'm going to say this rally's rolled over, and there's probably a fair bit more to go. If we can hold here, and that is still probably what you want to assume, give this rally the benefit of the doubt and say we'll still see some demand come in at 7,100, then we want to see a close above 72.57 to have any confidence that we can pull out of that worst case scenario, and of course a close above 73.76, and we will go back up and test those highs where I have said in the past I think you want to take some off the table. Looking at again the All Ords down 0.9%, but within that the worst performers there, gold pulling back. We saw the gold price obviously pull back. Materials, we saw some sharp falls in those industrial metals prices, but the iron ore sector within that was still very strong. So BHP, Rio, Fortescue and Mineral Resources. Utilities down on the rise in interest rates. We saw those Aussie bond yields heading back up. Utilities tend to suffer when that occurs. Property, however, bucking the trend up 1%, and energy rallying on the back of those rising energy prices. Otherwise, a bit of a much of a muchness from their discretionary down 2%. That's not obviously great for and reflecting those business and consumer surveys. Having a look at some of the technical factors now. So what we're doing here is we're measuring the number of stocks in the ASX 300 that are trading above their 5, 10, 21, 42, 63 period moving averages. So the more stocks you have trading above these respective moving averages as a proportion, so you can see the percentages here of those stocks, that is a more bullish sign. If you have 2/3 to 3/4 of your stocks trading above your moving averages pretty much across the board, you are 100% in bull market territory. That's the green zone here, and you can see they are our 2021 and 2022, it should say, to be fair, all-time highs. That's where we are trading in a very strong and broad rising market. We nearly got there. You can see these are the December 1 highs. So if I go back to the ASX 200 chart, we're talking about 73.76. The day we printed 73.76 is the yellow line. So you can see how much damage has been done since then in terms of deterioration. So whilst we were starting to look pretty good, you can see that the deterioration has been rapid and quite substantial, and that is concerning. And we're seeing many more trends here becoming quite mixed. So technical trends of the indices, and I always say, look, stick with the double greens and look for shorts in the double reds. So discretionary is still very much under pressure, and again, that's a sector you would expect to suffer in harsher economic times. Worse from there, maybe healthcare looking a little bit flat, neutral. Information technology still set to the downside in the long term, only neutral in the short term, and staples. So a lot of these consumption-based sectors looking very weak. Best ones, double greens there, is still very much the materials sector, although we did see that start to pull back last week. And then maybe utilities is probably second best, and they are a very mixed bag from there. So I can't really say, hey everyone, this is the sector you want to go and target this week. It's just not reflected in the technicals. Having a look at some of the value-based indicators, highs. We can see that the broad-based ASX 200 getting back pretty close to fair value there at 14.5. We normally say that 15 is fair value, 20s or above is expensive, and you can see the COVID peak coming in at 20, like clockwork, like it did in 87, like it did in 29. We see readings above 20 at the tops of bull markets, and then we see readings around 10 or below at the bottoms of bear markets. I can't remember what we got to, but it was in the 12s. This only goes back to last month to give you a comparison, but I'm pretty sure it got down to the 12s. So it did get cheap at the lows. We've got pretty much back to fair value, ironically, as the market starts to turn lower again. In terms of the best value sectors, it's still showing energy, but energy is cycling that big pop in crude and natural gas prices we know is not there anymore. So a little bit of skepticism required on that one. And then materials, very similar as well, cycling some highs, but starting to converge on its pre-COVID long-term averages. In terms of expensive sectors, let's say that healthcare is still looking substantially expensive there, with a PE of around about 33 compared to its long-term average closer to 28. Information technology has started to move back to the more expensive side. It got pretty close to 26 not that long ago. You can see there last month's number. And other expensive sectors here, telecommunications, look at 24 compared to 14.5 pre-COVID, I would say is very expensive. Utilities still looking pretty cheap there. Financials looking probably on the right side of cheap. And then I think much of a muchness from there. Okay, looking ahead to the week in data for Australia, monetary policy meeting minutes coming out on Tuesday, where the RBA will give some rationales for their recent 25 basis point increase and hopefully give us a bit of an outlook for 2023. And then looking abroad, we're going to get a bunch of US property